Invest boldly, maximizing returns with 100 LTV commercial real estate loans. If 100 LTV commercial real estate loans sound like a mythic financial unicorn, think again. These high leverage loans are very real and can supercharge your crescent investing. I'll walk through everything you need to know about maximizing leverage with 100% financing. Carefully evaluating the LTV ratio is key for both lenders and borrowers when assessing potential commercial real estate financing deals and structuring appropriate terms. The LTV has major implications on the overall risk profile and viability of the deal. Importance of LTV in commercial real estate loans. The loan-to-value ratio holds major significance in commercial real estate lending deals for several key reasons. It directly impacts the lender's risk exposure. Lower LTVs mean the borrower has more equity invested, providing a cushion for the lender if the market value declines. Higher LTVs indicate less equity. This leaves the lender more exposed if defaults occur. The LTV affects the borrower's monthly payments and overall affordability. Higher leverage loans require smaller down payments but usually have higher interest rates and payments. Lower leverage entails more equity upfront but smaller, more manageable payments. It influences the overall loan terms and structure. High LTV loans may require added protections like personal guarantees, extra reserves, or more stringent debt service coverage requirements. Lower LTVs provide more flexibility with the loan structure. LTV gauges the borrower's commitment to the deal. More equity invested indicates genuine commitment and belief in the property's outlook. Minimal equity raises questions on whether the borrower truly believes in the deal. The ratio factors into property valuations and appraisals. If an appraisal seems inflated to support a higher LTV, the lender must scrutinize it carefully. Conservative valuations help keep LTVs reasonable. It directly determines the maximum loan amount. Loan sizing formulas stem from the LTV, so inaccurate appraisals skew appropriate loan sizing. The LTV sets expectations for future leverage levels on refinances or additional financing secured by the property. Careful assessment of the loan-to-value ratio is thus crucial for lenders to mitigate risk, structure appropriate terms, and avoid problem loans. It provides key insights into both the property dynamics and the borrower's financial commitment to the deal. The LTV is central to prudent commercial real estate underwriting. Hard money loans. A quick overview. Hard money loans are a financing option for real estate investors that comes from private lenders rather than traditional banks. Here are some key things to know. Hard money lenders are usually high net worth individuals, investment groups, or private lending companies. They lend based on the property's value rather than the borrower's creditworthiness. This allows financing for borrowers who may not qualify for traditional bank loans. Hard money loans are asset-based loans secured by the property. This differs from unsecured bank loans. They typically have 6-18-month terms and higher interest rates and fees than banks. Interest rates of 7–15%. Origination fees of 2–10% of loan amount. Other fees like draw fees, exit fees, etc. The underwriting focuses on the real estate collateral and its attributes. Property type and location. Condition and renovations needed. Market value and potential appreciation. Existing debt service coverage. Hard money lenders can fund deals much faster than banks, often within days. Speed and convenience are a major benefit. Loan amounts can range anywhere from $50,000 to over $10 million. The loan-to-value ratio may be 75–80% for lower-risk deals, or 90% plus for riskier properties or borrowers. Hard money loans provide quick financing for real estate deals not fitting traditional credit-based lending criteria. The convenience and flexibility comes at the cost of higher rates and stricter terms compared to bank financing. Balloon payment mortgages and their implications. A balloon payment mortgage is a financing structure that requires a large lump sum payment to the lender at the end of the loan term. Here are some key details. It involves fixed periodic payments based on a longer amortization schedule, followed by a balloon payment at maturity to pay off the remaining principal. For example, a loan may have a 30-year amortization but a balloon payment after 5 years. This structure keeps regular payments lower. The periodic payments are based only on principal and interest. There is no reserve fund built up for the balloon payment. When the balloon matures, the borrower must make the large payment or refinance the remaining balance into a new loan. If property values have fallen, refinancing to pay off the balloon may be difficult or result in far less favorable loan terms. Therefore, these loans present a major risk if the borrower lacks the capital or financing options to cover the balloon payment when it comes due. On commercial properties, balloon mortgages may have 3 10-year terms prior to the balloon. Residential versions often have 5 7-year terms. Interest rates are usually variable on commercial balloons, while fixed rates are more common for residential. This structure benefits borrowers wanting low short-term payments or flexibility to sell or refinance. But it transfers interest rate risk and refinancing risk to the borrower. Lenders must carefully underwrite the borrower's ability to pay off the balloon through refinancing, sale, or available capital. Balloon payment mortgages can provide short-term flexibility but also carry risk. Both borrowers and lenders must evaluate the ability to handle the ultimate balloon payoff in structuring these creatively financed deals. Dealing with less than perfect borrower profiles. When commercial real estate investors have blemished personal credit or financials, creative solutions can still enable financing. Strategies for imperfect personal credit. Add a cosigner with stronger credit to the loan. Their profile offsets the primary borrowers. Focus lenders on the property merits rather than borrower FICO scores. Leverage business credit score if stronger than personal score. Provide larger equity contributions to offset credit weaknesses. Approaches for weak business financials. Include projections illustrating realistic improvement trajectories. Phase in new locations, expansion slowly with achievable targets. Consider SBA backing to reassure lenders on weak points. Opt for shorter loan terms to reassess at renewal based on updated financials. Alternative lending sources. Private, hard money lenders emphasize property merits over borrower profile. Crowdfunded loans pool investor dollars to fund deals banks may decline. Local credit unions may be more flexible than large commercial banks. Risk mitigation strategies. Lower leverage ratios and higher debt service coverage provide cushion. Seek partial guarantees from other entities to offset gaps. Prioritize reserves for interest carry, capex, etc. With a mix of alternative options and strong property fundamentals, financing is still attainable for borrowers not fitting a textbook ideal profile. As a final point, don't let this newfound knowledge gather virtual dust. Put it to action. Remember, the magic number is 888-653-0124. Give it a dial to dive even deeper into the world of high-powered real estate lending. Who knows, maybe one day you'll be the life of the party with your tales of 100 LTVs and property valuations at the dinner table. Until then, happy investing.